Costco, the safest stock on Wall Street. Or at least that's what everyone believes. But behind the scenes, there's a trap that could quietly wipe investors out. Costco's steady 10 to 12% growth has lulled investors into paying a forward price to earnings ratio of 50. That's higher than many of the overvalued tech stocks everyone loves to complain about. So today, ahead of Costco's earnings report, we're pulling back the curtain on the Costco trap. Why a 50 PE could destroy investors. Here's what makes Costco such a puzzle. Nvidia, the poster child for overvaluation, trades at a forward price to earnings ratio of around 30, while growing profits 20 to 30% a year. Costco, it's growing at about 10 to 12%. Yet, investors are paying a forward price to earnings ratio of 50 for it. That means Costco isn't just priced like a premium stock, it's priced like a luxury item. And here's the kicker. A lot of Costco's return over the last decade hasn't come from explosive profit growth. It's come from PE multiple expansion. Investors kept bidding the price higher, willing to pay more and more for every dollar of Costco's profit. But that's a fragile source of returns. Just look at FICO. FICO was growing at over 20% a year. The PE expanded from the 20s all the way to a sky-high PE of 80. When a competitor, VantageScore, stepped onto the scene, investors panicked. FICO didn't lower its growth forecasts, but the forward PE still collapsed in half and the stock price plummeted. If that can happen to a high-growth company like FICO, imagine the damage if investors ever rethink the price they're willing to pay for Costco's slower, steady growth. So what does all this mean if you own Costco? First, the risk. Costco's forward PE of 50 assumes investors will always pay a premium for stability. But if sentiment shifts even slightly, the stock could drop sharply, just like FICO's did. We talked about FICO's PE going from 20 to 80, but here's more context. It actually dropped from being in the 50s during 2020 all the way to the 20s by 2022. FICO's 20% EPS growth helped shield its stock price during that decline. Costco's 10 to 12% growth is excellent for a retail giant, but it's not enough to quickly recover from a price-to-earnings compression shock. That means a sudden rethink on valuation could destroy a big chunk of your investment, even though the company itself keeps performing well. On the flip side, forward price-to-earnings ratios aren't just about growth. They're about stability. Investors pay up for businesses they can trust to perform consistently. Costco's subscription model, loyal customers, and cash flow reliability make it one of the most stable companies in the market. If the forward price to earnings ratio holds at 50, your returns would simply mirror the company's growth. That's a steady 10 to 12% annual return. Not bad at all. However, there's a trade-off. A high price to earnings ratio limits what Costco can do with dividends and buybacks. Companies with lower valuations can have higher dividend rates or buy back stock cheaply, returning value to shareholders more efficiently. With Costco trading so high, buybacks won't move the needle much. Your potential dividend rate will also be very low. All of your growth will come from net income and the multiple investors are willing to pay for it. In short, investing in Costco is a bet on the market continuing to pay up for stability. It's not a bet on explosive growth, and that's a very different kind of risk than most people realize. Let's put this into perspective with real numbers. Costco is currently trading at $960 a share. I'm forecasting 13% EPS growth. If the forward price to earnings ratio stays stable at 50, Costco will slightly outperform the market. Costco will do about 84% over 5 years compared to 76% for the S&P 500, assuming the market grows 12% annually. My current price target of 1004 would represent only a 5% upside. At this price, Costco's future growth would match the stock market. Now let's look at what happens if the market rethinks the price to earnings ratio. If Costco's forward price to earnings ratio drops to 30 over the next 5 years, I'm projecting 11% growth, which trails the S&P. My price target in this scenario is 602, a 37% decline from today. Costco would have to drop 37% before its future growth would match the S&P's 12% annual return. If the forward price to earnings ratio drops to 20, even with 13% annual earnings per share growth, Costco would deliver a negative 26% over 5 years compared to the S&P's 76%. My price target here is 401, a 58% decline. Now compare that to Nvidia. Nvidia trades at 175 with a forward price to earnings ratio of 30. We're projecting 22% earnings per share growth. If the forward PE holds, Nvidia would return 170% over 5 years, compared to 76% for the S&P. Even if the forward PE crashes to 20, Nvidia would still outperform the S&P at about 80% compared to 76%, with a price target of 178. That would mean that the stock basically trades at fair value today if we are assuming the forward PE will crash in the future. The takeaway? There's a lot of risk in Costco if the multiple contracts. Unlike a high growth tech stock, its slower growth makes the stock extremely vulnerable to price to earnings compression. Costco is one of the best run businesses in the world. It's stable, profitable, and incredibly reliable. But its valuation is too scary to ignore. At a forward price to earnings ratio of 50, you're essentially betting that the stock market will always pay a premium for stability. That's not a bad bet if you're confident in the stock market's mood. But history shows us that even slight shifts, like what happened with FICO when VantageScore entered the scene, can cause valuations to collapse, regardless of growth. Costco's slower 10 to 12% growth doesn't give investors the same cushion that high growth tech companies have. A forward price to earnings contraction could devastate returns. For me personally, that makes Costco too risky to buy at current prices. It's not about the company, it's about the math. If the multiple stays high, you'll do fine. But if the forward price to earnings ratio drops, the downside is huge. If you're looking to buy, I personally would wait for the forward price to earnings ratio to return to a more reasonable valuation. On the other hand, Nvidia is expensive too, but it's high growth. Even if the forward PE drops from 30 to 20 over the next 5 years, it would still likely outperform the stock market. High growth companies like Nvidia are more resilient to forward price to earnings compressions, making them safer in these scenarios. That's the difference. Costco's stability commands a premium, but it's fragile. Nvidia's growth gives it a buffer. Investing isn't just about owning good companies, it's about paying the right price for the risk you take. And with Costco, the math is telling you to be cautious. So here's the bottom line. Costco is a phenomenal company, stable, profitable, and well run. But at a forward price to earnings ratio of 50, the stock carries hidden risks that many investors overlook. Its steady 10 to 12% growth is excellent for a retail giant, but it's not enough to protect against a cratering price to earnings ratio. History shows us that even high growth companies like FICO can see valuations collapse in a heartbeat. If the market rethinks what it's willing to pay, Costco could face serious downside, even if the business itself keeps performing. That doesn't mean Costco is a bad company. It just means the math and valuation matter more than the story. If you own it, be aware of the risks. If you're looking to buy it, patience could save you from overpaying for stability. Meanwhile, high growth stocks like Nvidia show why growth can act as a cushion. Even if the forward price to earnings ratio drops, the company can still outperform the stock market. That's the key difference between paying for stability compared to paying for growth. So, here's my question to you. Do you think investors are ignoring the risks in Costco's price to earnings ratio? Or is the stock market right to keep paying up for stability? Drop your thoughts in the comments. I want to hear what you think. If you found this useful, hit the like button so more investors can see. Thank you for watching to the end. I truly appreciate you. Bye.